So, good afternoon to everyone that joined us for our monthly PropFundrs community webinar. Thank you again to those who have taken the time to join live. And of course, this is being recorded. It will be on our YouTube channel. And then, as the regular attendees know, we take a number of shorts from this, some key educational points, informational points, and we stick it up on social media. So, very much around capturing the data recorded wise, but it's always good to have live people in the room. And normal housekeeping, if you have any comments you want to make, any questions that you have, particularly for Rory today, then stick it into the Q&A. Don't do the chat box, stick it into the Q&A, and that way we can manage it better. It also means that we can, if we don't get round to a question or if the conversation has moved on, then we can sort of circle back, grab the question, and follow up by email. So absolutely delighted today to have Rory O'Mara, Closed Bridging Finance. Rory, how are you, my friend?
Very well, David. Good to see you again.
Yeah,
Thanks for the opportunity to share some knowledge.
yeah, absolutely delighted. Say, I always really enjoy our conversations when we talk. There's always some real tangible examples of what's happening in the market. You're one of those guys I always say are right at the coalface.
Yeah, for sure.
Yeah, which is brilliant. So we'll be coming back to you just in a second, and we'll get stuck into this. So again, any points people want to make, get it into the Q&A, and we'll be able to follow from there. So and if there is any issues with my sound, Rory, just sort of jump in and let me know. Because I know we're having a few sound issues there, so don't be afraid to jump in if my sound goes. So today the topic
Sure.
is very much around why bridging, and we look forward to getting into the topic. But first of all, we are going to do our normal market news update. And for February, halfway through, I think in terms of house prices, still modest growth. Um, you could argue it's market stabilizing, but things do seem cautiously positive. If you go over to the right in terms of interest rates and lending, Roy, I'll let you maybe comment on that in terms of anything that's changed in the last few weeks.
I think from what I mean, I'm looking at it through the lens of, say, bridging and development finance. But if you're looking at the broader picture of residential mortgages and buy-to-let mortgages, I think the key thing is, David, lenders have money to lend, and they do have an appetite to lend, which is key. In terms of rates, products, say, let's look at term buy-to-let type products or HMO products, for example. They are more competitive now than they were, say, a year ago. Will rates go down? Who knows? They might drop 25 basis points. We'll just have to wait and see. I think it's very much in the hands of the Bank of England and where we are with inflation. But if you take the lead from where they are in America, their inflation has dropped significantly. And so hopefully that will happen here, but we'll just have to wait and see. That doesn't mean, however, that you can't go out and still do deals because good deals will always stack.
Yes, I think that's a really good point. Good deals always stack. I think that's very fair. And interest rates and lending is a moving feast. It changes. It's never static. Any more than a month or two is probably fair to say. So you've rightly identified some of
Yeah.
the factors in that. How does it affect your? Obviously, we'll be getting into your own journey more in a minute, but um, how do you stay on top of the changes? What's your normal method of trying to see what's happening in America, seeing what's happening here regarding lenders and interest rates? What's your format for that?
Yeah, so actually, funny enough, I use AI quite a bit now to write me daily, like a morning news report on the things that I'm interested in because it's very specific. So I do that. I keep abreast of webinars that lenders will run, just from a CPD point of view and just to be educated. But I don't get too focused or worried about it because I come back to this is our 20th year of lending and we will also broker. If you've got a good deal, then the deal will work. If it's not a good deal, if you're worried about a percentage point on an interest rate, then I think there are probably bigger issues at play because you're going to stress test your project anyway if you're going to keep it long term.
Yeah,
So yeah,
yeah.
but moving feast, David, you keep aware of it, but I don't get worried about the noise. It's back to, this. Everything I've always talked about is if your core strategy is right, don't worry about the noise.
hmm I think that's a really good mindset to have for this. So wrapping up the market news, regional picture, as always, there's a bit of um, disparity between various regions. At the minute, sort of the north, even Northern Ireland, is generally stronger currently, with London, the south, at the minute a bit slower. That's pretty much a trend, but still highly micro location dependent, as we know, all property is. You cannot be broad brush. Buyer confidence certainly seems to be improving over 2025. But again, region by region, it's different. So, yeah, that's just a very quick, brief overview of where we are. These don't tend to change drastically month on month, but we do just try and focus in if there's something specific has happened. But it's fair to say, since January, there hasn't been any sort of seismic changes in the economy or world geopolitics or anything like that will affect property. So let's get
Yeah.
straight into our special topic today with our special guest. Already introduced you, Rory, but what we thought we'd focus on today is sort of the headline: Why is everyone talking about bridging? And I know we're going to pivot towards the end into one aspect of bridging, particularly around the exit that perhaps some people don't think about or aren't aware of. But I suppose just first of all, give us a quick rundown on your background in either pre-property, into property, and what you do now with your closed bridging finance, please.
Yeah, sure. So we're into our 20th year now, David. So we started when it was very easy to buy properties below market value, no money down, and at that time you needed what was called a closed bridge or a daylight bridge, and that's where we were born. So we were funding projects when it was very, very easy to do them. We've moved on a hell of a lot since the easy days of 2005 through to before just the crash. And in that time now, obviously, we're lending for longer time periods, whether it's for bridging or slash development finance. We just look at the whole capital stack. So we work with borrowers to say the capital stack's made up of debt and equity. Okay, how do we fill the debt element? And that's what we do. So we lend, we also broker, and we will joint venture. So that's our expertise is what's the deal? Does it stack? Great. If it does, then let's move forward. And then in our kit bag, I guess you've got multiple products. So whether it could be a bridging loan or a development finance or mezzanine funding, which would be the top-up funding that we might do, and that might be coupled with, say, a profit share, for example. And then once you've done the project, are you going to sell or keep it or do a blend? You'll need some form of exit, and then we can we can do that as well. So that might be a buy-to-let mortgage or a commercial mortgage or an HMO mortgage. And part of that capital raising is also looking at maybe second charge loans as well, where you have other assets that aren't too highly geared. That's a great way of accessing additional funding. And then the bit that I know we're going to come on to because it's a hot topic right now, and that is sort of what's known as dev exit funding or development exit funding, and that's a real sort of lifeline for developers.
Yeah. So just in terms of what you refer there as your specialist funding, um, I'm going to just come off the screen for a second there to have this. So within the market, so there'll be some developers, on here live now, and there'll be developers listening to this particularly. It can be a very complicated lending market in the UK. There are a lot of mainstream lenders. There are those who focus on special aspects of that capital stack you talked about. Why do you think it's important that developers have a relationship with someone like you that has particular expertise? So what is that value that you and your type of organization brings to a developer?
Sure. So I think when we look at a project, with a client, the first view is, well, number one, does the deal stack? Actually, does it actually make sense? Is it viable? Because sometimes you can't see the wood for the trees. You're in it and you think it's a great project. And you find out, for example, let's put your developer hat on. Are you paying too much money for the land? And sometimes historically that would have happened. That landscape has changed significantly, I would say, in recent years. For example, the old adage was a third, a third, a third. A third was the cost of the land, a third was the build, and a third was the profit. Those days, David, are long gone. I would say land price to GDV, if you were buying, you're probably looking at between 19 and 24% today, subject depending on what you're going to build. Why? Build costs are significantly higher. So the first thing that we would look at is let's just analyze the deal. Is it really viable? Are the end values viable? The GDV really viable? And is there enough contingency in there? Because I can believe me, when we look at projects, contingency gets gobbled up very, very quickly, particularly on complex builds. And then we're looking at, okay, let's see the capital stack, the debt and equity play. If you're the developer, how much cash did you have to bring to the table? Let's say you don't have vast amounts. There are lots of creative ways that you can work. A recent project we had with a client, someone had land, but no experience. Well, we've structured that deal where you create a new special purpose vehicle, an SPV. You put the land into the project, but the owner of the land gets paid at the end when the asset is sold. So you're now only arranging finance for the build, significantly reduces your cost. And it's just understanding how to structure those deals. So that's the sort of thing that someone like I can do. And it might be where we'd say, actually, we can arrange the senior debt with, another lender. We might take a view and say, we can look at doing the top up funding, so the mezzanine funding, and we'll blend that. That might be with a rate and with a profit share. And that's a conversation to be had. And that's where I would see us as being different. If it's plain vanilla, it's very, very simple, David. Let's go get the best deal. And by the way, the best deal doesn't always mean the cheapest rate, which
Yes,
is
and we're
key.
definitely going to come on to that as part of a discussion. So let's start, if you like, right at the ABC. How would you describe bridging finance? So let's just take someone who's starting out the development journey. They know they need funding for their project. They're aware of debt and they're aware of equity, but within that space, there's quite a bit of variety of how the lending can be structured, and there's so many different products. So, how would you describe a bridge loan,
Sure.
a bridge
Okay, let's
deal?
keep it. Yeah, let's keep that very, very simple. I like primary colors ABC. Keep it very, very simple. Don't make it complicated because you should be able to understand it. A bridging loan, in its most simplest form, you're using a bridging loan because you can buy an asset quickly. And normally, in my world, that asset is not mortgageable. So it doesn't have a kitchen or a bathroom, for example. That's a very good reason because you're going to buy it and you're going to spend some money to add some value, David. Yeah. That's one reason why you might use a bridging loan. There are many other reasons, for example, why you'd use a bridge. But I think that's probably like buying at auction because you need speed. Very good example. Or you just want to, you need to buy quickly. May not even be an auction because it's like buying with cash. Yeah. Now, it's a gray area. And what I mean by this, you can get a bridging loan, but also a bridging loan with drawdown facilities. So we've funded a lot of these. Either we've funded them or we've arranged them. It's a hot topic today. I'm an investor slash landlord. I want a great return on my cash. You probably would do that with an HMO, a house of multiple occupancy. And a really good example of an asset that you might buy could be, say, a three-bed property that you can convert to a five or a six-bed with ensuite. If you do that correctly, and I've got a client, we've done lots of these over the years, probably 85 plus beds with a full-time job as an IT contractor, and that's all we do. Blinkers on, find it, turn it around. No, so that's a bridging loan, and you get the drawdown facility to do the work. And normally you'll get 100% of the cost of works in the facility, but you have to be mindful. The lender will come and inspect the work, and the funds are drawn down in arrears and in stages. So you need some float money to get going. So either very simple, a bridge just to buy an asset, Typically, I'd say in this market, you're probably looking at taking a bridging loan for about 12 months. Do not, do not take a bridging loan for 6 months. If you do, ring me before you're going to do it because you need to understand why. Most people will do it if it's promoted by a broker, will be because you'll get a higher day one net advance. But it's very rare that you'll get in and out of a bridge within 6 months unless you've got a compelling reason. Then obviously there's the drawdown, which we've talked about. The last bit would be development finance, which is more complicated. And I normally call that for ground up new development, which also has drawdowns. But that's just where you'd look at a bridge.
Yeah. So you definitely want to unpack that a bit around two things you said there that I think are really important for the attendees. Um, Number one is don't always look at just the interest rate. That is key. So let's start with that one. So, well, why not? Explain why not.
Sure. There's always more to it than just rate. The rate is obviously very important, but you need to understand what is well, number one, what is the rate? There will normally be a lender arrangement fee. That's typically 2%. How is the interest being calculated, David? Is it being serviced, which is very, very rare that you physically would send the money to the bank or the lender monthly. Very few people would service a loan. The loan is either retained or it's rolled up. Typically, it's retained interest, and it's just important to understand that because I have seen some lenders claim, I'm going to lend you 100K and charge you 1%. They say it's rolled up, but it's not. It's retained, and you need to understand. The retained loan is where you'd have the gross loan for the 12-month period, and so it would cost slightly higher. So that's one element of it. The other thing is, and it's not uncommon now, lenders will give you a rate. That rate is not a fixed rate, David. It's a variable rate, but it's not always clear. When I lend, my rates are fixed. So if we agree a 12-month term, that's the rate. It's got nothing to do with interest rates going up or down. But some lenders have a variable rate, and actually they'll charge you when it ratchets up, but you don't get the benefit when it ratchets down. So again, if you're working with a broker, ideally you really want to work with a broker who works in the specialist finance arena who understands this. So it's understanding the dynamics of what does that even mean. Yeah.
Mhm.
And obviously you'll pay for drawdown money. But if you had a facility where you didn't draw down, it's not uncommon to be charged a non-utilization fee. So for example, if you've got £50,000 you've not drawn down, the bank's not going to leave that in a pot and not charge you for it. So again, it's just understanding what the non-utilization fee might be. Sometimes there are exit fees, sometimes there aren't. It's more applicable maybe for development. But again, it's just understanding total cost. Also, what's the minimum loan term as well, David? So it
Yeah.
might be 3 months, some cases it might be six. So you factor all of that in. The final piece is, which has got nothing to do with rate. I've got lenders that we work with. We have great relationships where I can ring an underwriter and have a proper conversation.
Mhm.
You can't put a price on that
Yes. No,
because that's a direct hotline.
that's a very good point. A very good point. So if I summarize that, the rate is obviously important because ultimately that's the main cost of the funding, clearly.
Yes,
But what you're saying is there are very often other criteria, um, other fees. They differ depending on the source of funding, and as being aware, developers need to be aware of what I call the real cost of money, i.e., the
yes.
rate and all the hidden fees, all the charges, all the extras. That very often is a significantly different figure than just the interest rate.
Absolutely. And just to throw you completely off scent, I have a client from many years back who rang me who said, I desperately need a bridge to buy this property. I said, just tell me the story. My reply was not what he was expecting. Because I went, you don't need a bridge. What I would do, because he told me where he was in the transaction, I said, just go back and renegotiate. Say, can you give me breathing space? Because he actually required a buy to let mortgage, but they're not quick. So why don't you go back to the vendor and say, look, I can't remember the exact amount, but let's say it was 500 quid a month. If I pay you 500 a month, give me an extra couple of months. Would that work? The vendor said, yeah.
Mm.
And the client came back and says, well, how do you make any money? I said, we don't, because what we'll do is we'll find another project that actually would be more appropriate.
Yeah.
Now, bizarrely, time passed and he came back and actually said, I really do want the bridge because I want to do major works to the property now. But that was fine. So I would always look at creative ways. Are there other ways of being able to negotiate to do deals?
Mhm.
So sometimes you don't need a bridge.
Yeah. Okay. So, moving on again, something else you said, and we've discussed this in our various conversations in the past, and that is, and you alluded to it, which was great that you brought it up. That is the length of the bridge, and the tendency for developers is, well, I'll take the bridge for the shortest possible time because I want to keep my costs down. But earlier on in the conversation, you said don't take a bridge for 6 months, for instance. Uh, you know, obviously you've got a reason for indicating that. So rather than stealing your thunder, I'll let you explain what you mean by that. So I'm a developer, I can get money for 6 months, but you're saying be careful on a 6 month bridge. Again, why are you saying that?
And the best way to illustrate that, David, would be always via a story. So I had through a client, the solicitor actually rang me. So the solicitor acted for them on a loan that we did. Sister rang me, said, Rory, we have a client. He's in a bit of a pickle. Can you have a conversation? I said, sure. So I have a chat with the client. He's a builder. He bought a plot of land to build some houses in the north. I said, take me through the numbers. And he was on a 6 month bridge. And I went, so I don't understand. So you secured the land with a 6 month bridging loan. You've got planning, and I think it had planning. I can't remember. But I went, I'm just concerned. So what's the problem? He said, well, I've run out of time now, and the lender wants their money back. And I said, how much did you put in? Well, the way the loan was structured, and it's quite common, he put a second charge, or they were allowed a second charge on his principal private residence. So he's in a bind now. So I said, okay, so can we just go back and analyze the deal? So keep it very simple. He said, I can build at £98 a square foot. Well, you can't. He said, I can. I said, okay, you might be able to build at £98 a square foot, but that will not cover any of your profit.
Mm,
And I'm pretty confident because I know most of the lenders. There was a broker involved. And the broker went out to find lenders to then do the development finances. Yeah, they said no one would touch it. I said they won't because they won't fund at £98 a square foot. It's just not realistic in today's market. He said
yeah.
that's the problem I've got. I said, and I can't help because I can't find a lender. The problem was I don't know who was too eager to do this deal. Was it the broker or was it the client? But the
Mm,
deal was done on a 6 month bridge. He ran out of time. The only option that I could see, I said, you might want to go back to your residential regulated mortgage broker and refinance your main home
mm.
because
Which
you
which
need to
is
find a way.
just scary when you start putting your own assets on the table for business.
It is. And again, well, actually, he should never have bought the land, David. The deal didn't stack. And you know this, I've known you for many years. Everything I do, the foundation is strategy. Does this stack? Does your deal stack?
Yeah.
Jumping in 2 feet, getting a 6 month bridge, hoping and praying that you might get a development finance. I said, I'm sorry, it's very rare. I said, that's the only practical solution that I think. Go speak to a regulated mortgage broker, see if they can find a way to refinance you so that you can obviously get rid of it. And you're going to have to sell the land on or find another person to work with. But so there's an example with a bit more time added, but actually even before the time, looking from start to finish and realizing if that would be the first question I'd ask, give me your build costs.
Mhm.
£98 a square foot, no one's going to fund you. And the broker
Yeah,
should have
yeah,
identified that right at the outset. So that's just an example.
yeah. And I think what's really important, as you've told that story and framed it, and you alluded to it there, that had that person have come to you, that developer right out of the gate, you would have been honest enough with them. And I think that's the
Yes.
right term. And I don't mean honest in terms of honest and dishonest. I just
Yep.
mean honest in the sense of being upfront and clear, giving your professional opinion on a deal, and developers don't want to hear that. In my experience, and we have both been dealing with developers
Yeah.
for many, many years. You maybe slightly a few more than me, but for many years.
I know I look a bit older, a bit grayer.
But the reality is developers very often are emotionally attached to their deal. They then go out with that emotion looking for funding, and if they can
Yeah.
access funding to allow them to pursue their passion of that deal, they don't always make an informed decision on the funding. I think what you've alluded to is being able to say to someone, okay, you might like this deal, it might suit you for whatever reason, but ultimately, if your funding of that deal doesn't stack up, you're walking into a minefield. Is that
You are,
fair?
and that example of leverage, highly leveraged with your principal private residence on a second charge, which basically was telling me, and this was a couple of years ago from memory, he has no cash. Well, you need
Mhm.
cash because you need a float to do the build. Now, it might have been possible, David, maybe with a joint venture partner who had cash to actually analyze the deal properly and go, you know what, it might work, but you've got to evidence me at 90. I mean, that's a very low build cost.
Yeah,
And so I would struggle to, even then, I'd struggle to see how you could do that because you'll need contingency, and that contingency's got to come from somewhere.
yeah.
So
Well,
yeah,
I
so
can.
that's an example of time. So just to wrap that bit up on timing, what would I normally do? I would look at a project and go, okay, so let's say it's an HMO conversion, for example, depending on the budget for the refurb, let's say it's 80, 90K, for example, if it's a simple one, you should get that done within maybe 4 to 6 months, depending on complexity. So you're probably going to be on a bridge for 9 to 12 months. I'd always allow for the 12 months if you're going to refinance it. Why? It just gives you a bit of breathing space. What you don't want to do is to be at the mercy of the lender and be mindful, folks, if you're refinancing assets, it does not take 4 weeks. We did a hotel conversion from a hotel to 9 flats in Blackpool. Funny enough, I was at an event last night, one of the property and Poppadom events near me, and we were going through this with another investor. It takes time, and it took 5 months for that investor because he went to a different broker because he was trying to get a cheap mortgage, of which there's no such thing. It took 5 months for the challenger bank to refinance him off our bridging loan.
Yeah,
Um,
yeah.
and so, again, that's why I think the 12 months developments, just to move it on a step very briefly, David, development funding now, we're looking at 18 to 24-month projects in terms of time.
Mm. And that makes sense. I'm going to give a again tangible example, and there's been a question come in there from one of the attendees around insurance,
Oh, I see. Yes.
which is interesting. But set it up by saying this first, and then I'll let you deal with the question. So, tangible example. I was a part owner of a property down in Brighton. It's just still am, but we it must be 16, 17 months ago. The property was in a little bit of a distressed situation regarding the owners. Um, and they were a motivated seller, particularly because of the finance was coming to an end. The bridge was coming to an end. I won't mention the bridging company. They were flexible to a point, but then it got to the situation of
Yeah.
conversations around repossession because they kicked the can down the road. So now there's an owner of a mixed use property, very specialist property, bridging company saying, listen, deadline date, we have to look at repossession. I mean, that's just the edge of a cliff. We then I was part
Yeah.
of the group that came in and purchased it, and we bought it on a bridge. We did go the year rather than 6 months, and even then we got quite close, maybe 6, 7 weeks out, even though we started maybe 4 months earlier to go on an
Right.
ordinary,
Yeah.
on our ordinary lending. And I can remember the
Yeah.
cold sweat on the brow, Rory, as we're
Yeah.
watching the clock tick down to a potential repossession of the asset. I mean, it's
Actually, I
scary. So
recall that, David, because I was on holiday and you rang me. I think I was in Italy and we talked about
correct,
that project. And
correct.
I
That's right.
think I bowed out, said, "Look, if you're under that time frame, it's like, look, I'm not at my desk, so I'm not going to try and waste your time." But just allow contingency in budget for cost in terms of build cost, refurb cost, and definitely allow lots of time to get off a bridge, for example, if you were moving on to a term loan or if you're trying to sell, because all it takes is someone in a chain well and truly outside of your control, and then you're into all sorts of default fees, and they ratchet up, and that's how bridging lenders make their money. So
Yeah,
yeah,
no,
yeah.
that's fair. So in terms of insurance cover, is it possible to take out insurance? I know you can get like obviously natural disasters, the person asking the question, but is there a way of insuring against hitting a deadline with a bridger and not having the funds? Is that possible?
Not that I'm aware of. I mean, let's say you have let's say this is a development. You've got a main contractor, for example. Um, you probably want a half decent contracts administrator and the right team advising you. You'd have it maybe the correct JCT contract. And in there, you could probably add penalties if the main contractor, for example, has failed to deliver on time. That's one way potentially of trying to protect yourself, David. But a lot of
Yeah.
people don't want to do that. But I'd go bring the right people into your team to do that so that you can get protected. But on smaller projects, they'll probably tell you where to go and say, well, that's it. You'd have to take that view. So no, I'm not sure that you'd be able to get specific insurance related products for that. I think that would be quite complicated to even try and underwrite.
Okay. Okay.
But hence why I've mentioned, you need with a good build program, schedule and cost of works, and the right contract administrator, say if you're a developer, for example. Yeah.
Yeah. Okay. Now, one thing we talked about, which I think I'm really keen that you go through this, and that is
Yeah.
people, most developers, and even in my experience, they only ever really think of bridging in the first instance when they are at the start of a project, i.e., how do I secure the asset? As you say, maybe it's in a state where it can't be lent against or whatever. And there's a lot of focus on, well, I'll buy it on a bridge and then we'll do what we have to do and then we'll go and refinance it or sell, the case may be. But I know from speaking to you and maybe set this up about the state of the market, given the last couple of years and the amount of projects that have been delayed and material costs going up, labor costs going up, house prices fluctuating. You're doing a lot of business at the minute with developers, a lot of business around more the exit type type finance and bridge. So just speak to that. I think you then got a bit of a tangible example as we sort of move to
Yeah,
a wrap up here in the next sort of five
sure.
minutes.
So yeah, no, that's fine. So this is just an example of so if you look to the right of the screen, folks, you can see a wonderful garden on an incredibly steep hill. So really complicated to build in an environment like that. But that's an example of a project that we have worked with a senior debt provider. We've done the MES funding, put the whole project together with the client. And that's a CGI, but actually the project is finished. It's on the market. And but like all these things, if you move to the next slide, David, if you don't mind, you'd have your normal time frame for your development finance, and when you get towards the end of your development finance, and I'd say, so let's say you had an 18-month facility. Well, around month 14, I would say you want to seriously start thinking, what is my exit? And if you've got a potential sale going through, that's fine. But you do not want to go beyond the 18 months or you'll be in breach of contract with the lender. And then that triggers all sorts of additional costs and fees. So a lifeline to developers now is a development exit facility. And some of the bullet points here why you would use it. And this is becoming more common when I speak with other lenders and I understand what's in the loan book, particularly for the more complex projects, they're running out of time. And if you run out of time, then you want to move to a dev exit facility. So, number one, you want to avoid a fire sale. So, you've got a great product. You want to sell that ideally at a premium price, and you don't want to be under pressure to discount heavily. The interest rates on dev exit should be lower than they are on the physical development finance. The asset exists, it's near completion or it's at practical completion. And those rates would be certainly sub 1%. Again, depending on what you've built, you might be able to release equity. So you've got some capital that you could use maybe to go on to another project. And also you just need time. So this is the perfect time now. We're sort of, mid to end of February. Buyers are actually going out and looking at properties that they might want to move into. And so you want to be ready now. So you want to extend that sales period so that you're not under pressure and you end up in some form of default. And also, you can finish your sort of the final works as well and get to practical completion. I think we've got another slide there as well, David. My memory
Yep.
serves me right. Yeah, so when you start to look at the sort of options, standard development exit, think of it as a bridging loan. You've built your house or two, you're at that point where it's at practical completion. So, you've got building regs signed off, you've done a couple of new builds, say, the warranty is signed off, then, you can get to 70 to 75% loan to value, sometimes a little bit higher if you have additional security. I had a client I worked with for about 11 years and we were funding a lot of its HMO conversions at not far off up to 100% because we had access to another unencumbered property with no debt on it. So we were always able to add two properties into the mix, which was interesting. The second one is just finish and exit. You've just got a little bit of work to do. Get me off the development finance and obviously start to reduce my costings. Or you might want to do part sales exit. So say you built four assets, you might want to sell them. As you sell them, then you can repay, and you might even look to retain an asset or two. I've worked with some developers over the years who said, "Yeah, actually, well, I was with a client actually last week, and they've got 22 flats that they've done a commercial to resi conversion, David. They know they can't sell them all because it's just too many to sell at one time. And half a dozen of those they'll retain on buy to let, and they're quite happy to add them into the portfolio. In terms of loan sizes, yeah, look, the money's out there. Time frame, I'd say on a dev exit facility, depending on the project, wouldn't be unreasonable to probably run with a 12-month term just to give you time. And the security is, well, the asset that you've built. But the good point though, if you've got additional security, now that could be a second charge on your main res, which you might have to do, or say if you had some buy-to-let or other commercial assets, as long as there's equity and they've got low gearing or low leverage, then that's something else that could be used. But this is a very common product now, and definitely if you're at that point where you've thought, look, we're near finish, but we've not sold, well, don't panic. We
Hmm.
can look at dev exit as a potential solution. Yeah.
Yeah, and I think what's keen to highlight is given what's happened in the market, as I said a few minutes ago, with the challenges that many developers have faced with a delay in sale beyond what their original plan was, that has led to a lot of challenges with the exit of the asset. So for you to be able to step in with a product that identifies that particular challenge and helps to solve it, like I think is massive in the market because it could rescue a project that has just hit some challenges that were unforeseen at the start point.
Yeah, for sure.
I think that's absolutely key. Okay, one more thing, and then I'm going to have a couple of slides to wrap up. And then you can have a final 30 seconds of pearls of wisdom, however you want to use that time. I know the next slide, which is actually yes, your details. So I'll leave it up while I'm talking, so people can grab that, screen grab that, or whatever they want to do. But you said it at the very start, and you said it
Yep.
there at the end. There's plenty of money out there. Is that, I mean, very often developers, again, sometimes I don't think realize that the criteria of lenders obviously is important because different lenders and different organizations that fund, well, any part of the capital stack have their own criteria. But, you've alluded to it twice and just to emphasize it, there's plenty of money in the market for good deals. True or false?
No, absolutely. If you have a deal that stacks and makes sense, I think the key thing from a lender's perspective, they want to know that you've got a track record. So that's probably if you're a newbie, it's challenging. But if you're an experienced developer with a track record, you can prove it. The deal stacks. There's no shortage of lenders. Lenders are contacting me. Look, do you have opportunities that we can fund? So yeah, there's no shortage of money. I think the thing is being able to just does the deal stack? Are you buying at the right price? You're not spending too much money on the land, for example, and you've nailed down your building costs, David. So they're not £98 a square foot, for example.
Point,
Yeah,
point well made. Brilliant.
yeah,
As I say,
yeah.
I'm going to give you 30 seconds at the end, but yeah, so just to remind our regular attendees, or if you're watching the recording of this, you can go to our YouTube, the Property Funding Podcast, and you'll see a whole different bunch of people involved in property, from developers to lenders, to people who do buy to let, planning, the whole range. The last one that we had launched there was with Angus Griffin, who was an ex-FCA enforcement officer. Fascinating guy. Does a lot in sort of the north, in the buy-to-let market, but really has an interesting model. But yeah, there's something for everyone on the podcast channel. And I dare say I need to get you booked in, Rory, to get you on to hear more about your full story in that
Yeah.
time.
No, I'd love to
Um,
do that. Yeah, let's set that up.
that'll be good. So again, just reminding everyone, what is prop funders? We've had Rory, who's obviously clearly experienced in what he does, on here, because what we do as prop funders, is that our mission, what gets us out of bed in the morning, is saving property developers and investors time and money, by helping with the structuring, the sourcing, and simplifying property funding. And therefore, we work with people like Rory. His expertise. If there's something comes up, that particularly around some of the things he's talked about, and the value that he's been able to bring to his clients, regarding some of the issues around funding, then we can simply plug you into Rory. You saw on his card there, he does sort of free consultancy calls initially out of the gate, just to touch base. And it may be that you could find your funding that you need to start or rescue your project, through speaking to Rory. So that's what we do. We connect developers with funding sources, and that's key. So again, if you want to have a chat with me, you can obviously book there a free call. Always happy to talk to new developers. I even do that with some of our existing developer database. And we have well over 1,100 investors on our database. Around about 300 developers are on our database in terms of communication. So again, always happy to connect with people and try and help, and where possible. So feel free to grab the Bitly link there, and book in. And it's always enjoyable meeting new people. So next month, really delighted. Next month, Sarah Poskett. For those of you that know Sarah, she does a bit on social media. She does a wee bit of mentoring, but she's got a really good track record of delivering projects. She's done some buy-to-lets. She's also done mixed use, HMOs. And yeah, so Sarah has I've been chasing Sarah probably for about a year. It looks like we finally got our diaries to merge. So that will be the 18th of March at 1 p.m. for our next community webinar. I don't know if you know Sarah at all, Rory. You ever come across Sarah?
I don't know if I've met Sarah, to be fair. David, no. But
Okay,
I'll
no
do
worries.
my best, see if I can tune in. 18th
Yeah,
March,
no,
1 o'clock.
no, 100%
Yeah,
there. So that's the next one. You'll hear more about it.
yeah.
And yes, so last thing is we have a couple of sort of educational webinars coming up, sort of Zoom calls, and this is with land profits. So Ella is one of our clients, working very close with Ella in terms of funding some of her projects, and helping her with her really scaling her business. We've got one on the 2nd of March at 4 p.m., another one on the 9th of March at 7 p.m. So this will be Ella going through a case study of one of her current live projects that she's working on. And this is very much around the planning uplift. And Ella does some phenomenal, amazing um, things in this space, working with investors and putting projects through planning. She's got a really good team of people behind her. I thought it'd be really, really good opportunity to let people learn more about both the development side, and those who may be interested in investing in this type of project. Investing in this type of project is for high net worth, sophisticated only. I want to make sure I make that clear. But if you qualify for that and you're designated, then you can be introduced to some of the projects that Ella is doing. So you can DM us for that. Again, we'll be sending out to your high net worth database as well, but certainly reach out to us on that. And that is me there. So, Rory, I will give you your last sort of 30 seconds of anything you want to just highlight or comment on to finish off, please.
Yeah, sure. Look, it always starts with a conversation. So, if you're thinking of looking at a project or you have a project and you just want to talk through the money bit of the jigsaw, I'm always happy to have that call. And there's my contact details, my phone numbers there. But yeah, get in touch. Always happy to have a call.
Brilliant. Okay,
Okay,
that is
David.
us for today. Thank everyone for joining. This will again be up on the YouTube quite quickly, and we'll be able to watch the recording and get our shorts out. So thanks everyone who's joined live. Always appreciate that. It helps get the interaction going. And Rory, thank you for your time and sharing of your wisdom and your knowledge, which is always important when it comes to business and property. And I look forward to speaking to you again quite soon. Bye, everyone.
That's lovely.
Bye
Thank
bye.
you, David. Thanks,
Bye
everybody.
bye.
Bye for now.